The usual advice given to financial institutions to prevent scams, check everything with a phone call, make sure emails don't sound off, is becoming less useful. What can institutions do to protect themselves?
I'm a massive skeptic of the benefits of AI because so far, at least in my profession, AI has been used to conduct more fraud than help detect fraud.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast. Brought to you by Trade Finance Global. Hello and welcome to Trade Finance Talks. My name is Charles Osborne, Director at Trade Finance Global. Today I'm joined by a very important guest, Jonas Ray, founder and partner at Athena Intelligence. Welcome, Jonas.
Thank you. Welcome.
The title of this podcast that we're doing here is Fighting the Many-Headed Hydra of Commodities Financial Crime. So very, very important topic. Fraud and financial crime has, very much came into the forefront of everybody's mind, particularly since the very high-profile fraud cases at the beginning of 2020. It's an increasingly interesting subject, one that I've been very personally interested in talking about. Jonas is very much the expert here, so delighted to have him join us to answer a few questions. Maybe we could start actually, Jonas, if you give a very quick introduction to Athena Intelligence and the type of work that you do.
For sure. So I have founded Athena Intelligence in 2019. It's been 6 years now, going into 7. I have a 15 years long career in investigation in general. And I think I've been fascinated by trade finance and trade finance related fraud. This is actually my first case. When I started my career was the Bali Steel case that happened at the end of 2012, beginning of 2013. So I've seen a lot of cases and companies go under because they have committed fraud. And as a result, we've developed like a niche expertise in looking at trade finance fraud, trade-based money laundering, and any other type of trade finance fraudulent behaviors. I've seen cases in Europe, I've seen cases in Asia, in Africa, in Americas. Every continent is affected by this, unfortunately. But it also gives us a good insight into the do's and don'ts in trying to prevent fraud from happening as well.
Fully agree. This is such an important topic. And I know it's one, you and I have spoken about over the last few years privately many a time. And we've been lucky to work with Jonas on our conferences as well. For me, this is a very integral topic. Perhaps maybe we can start quite generally and ask the question, are banks and FIs effectively putting in measures to mitigate risk and prevent fraud? 5 years on from 2020, what's kind of happening here?
For sure, the banks have learned. It was a painful learning experience, but they have learned, that is for sure. So they have put a lot of procedures in place to try to deter fraud and better detect it. So obviously fraud will never go away. I think it's an illusion to believe that you can totally root it out. There will always be a percentage of risk that is related to that, but the goal is to limit the amount of instances of fraud that you have as a financial institutions and also the size of it. I think what was absolutely traumatic for many banks and financial institutions in 2020 was the size of the fraud, with company worth billions of dollars going under, leaving massive amount of debts on the hands of these banks. And I think it's what made 2020 unfortunately unique. It was the sheer scale of the problem. And I think this has forced the banks that have decided to stay in this business segment to implement very different, let's say, due diligence, compliance, transaction monitoring process they used to have before. And I think it has made them stronger. That is for sure. So they have learned. Can they do better? Yes. One of the risks as well of wanting to prevent fraud at all costs is that you make it as well very difficult for smaller player to get financing, simply because some financial institutions have decided that it's actually too risky to finance mid-cap players in this sector, and they'd rather just stay away from them altogether. That I think is not ideal that they have done this, but it's a business choice. So yeah, I think they have learned, they have processes in place that are new, that are so far working, because we haven't seen as well a massive trade finance fraud in the last 5 years, which is a good sign. And I think, I hope it will continue. So yeah, they've learned for sure.
Thanks very much, Jonas. And a very interesting point that you made in regards to sort of the SME mid-cap and the flight to quality that we saw in the intervening years between 2020 and now. And it's still kind of very much going on. We at TFG are very much highlighting the trade finance gap. And this is something that is very, very important. I would ask a quick question on the role reputation management plays in the fallout of financial crime. You highlight, obviously, very importantly, the cases in 2020. Have we sort of seen players of a certain size, unfortunately, tarnished purely because of mistakes made by companies in a similar position?
Financial institutions are much more scrutiny into the reputation and the perceived reputation. So I think the important part here is that we have moved away from a place of truth to a place of reputation, where truth has somehow become secondary to the reputation side of the business. So if you have a business that is perceived to be above any suspicion, it will look great for you and it will open a lot of doors, even if the truth is a little bit different. When you have a fraud case that impacts a company or a sector or an industry, it automatically tarnishes the perceived reputation of essentially all the players involved. Even if from a truth or fact perspective, not everybody has been impacted. So we see the management of the reputation and especially the how to better explain and manage negative reputation or negative elements in the reputation has grown in importance, both on the trader side and also on the financial institution side. The banks and funds, they're being much more alert to negative news. They are putting a lot more weight into this. And yeah, I think it forces, especially the mid-cap traders, to put a lot more resource into managing this if they want to have some of the institutions to open for them.
Very interesting points. Moving on to sort of the length some of this takes as well, I do wonder if it's somewhat of an incentive for would-be financial criminals. Why is litigation so cumbersome in international financial crime? In some cases, many cases are taking almost a decade to reach the final judgment. So would you say that's a bit of an incentive for anyone wanting to kind of commit this? They're not really going to see any retribution for quite a while.
I don't know if it's an incentive, but for sure, there is no more deterrence effect from litigation. I mentioned Bally Steel before as my first case. That case was started by the Serious Fraud Office, which is, a very large, well-funded fraud investigation organization from the United Kingdom. And even for them, it took them 10 years to go from investigation to conviction. And during these 10 years, the people that were in the investigation, they could pretty much, go around, and obviously they had to participate in the investigation and the litigation, but they could still go around and operate businesses and keep on going with their lives. So obviously, it doesn't really deter you to conduct a fraud if even some of the best investigation outlets or state agencies are taking so long to come to a resolution. Now, just imagine you have a fraud of similar magnitude in a country where institutions are not really well trained to investigate cross-border transnational crime. It's very tricky. And I think there is some inherent predisposition in trade finance because you're dealing with something that is so global. So every shipment of commodity between company A and company B involves 5, 6, 7 different countries. That means 5, 6, 7 different jurisdictions, different set of rules of law. And then once there is an issue, the investigative authority needs to contact the different countries and ask for help. And as a result, that is taking very long when it is happening. And it's inevitable that the person that are committing those frauds are abusing the system. And that is what we're seeing. So I think the issue is it's not so much the commodity sector, it's that the legal world and the investigative powers are not yet adapted to trade and a business or an industry that is global in its essence.
You mentioned a good example there. Obviously, you can't go into too much depth about some of the example cases that you've worked on, and I do appreciate that. But we did see recently in the piece in the FT about Niels Troost, which was a Swiss commodities trader sanctioned by the EU for trading with Russia. So his story was covered by the FT, and I believe it was one of your clients and Athena's clients. Obviously, you can't go into too much depth over that, but how would you say smaller traders and commodities firms are grappling with sanctions and tariff compliance and getting around some of those issues?
I think there is the tendency to be a little bit too legalistic when it comes to sanction compliance. A lot of the traders that we help, they have the view that, okay, we have a legal opinion from one of the top law firms saying we can do this trade, so we go ahead and do it. But I think what they fail to recognize is that at least the UK and the European Union current sanction regime is much more political than legalistic. So even if you're doing something that is perfectly legal where you're doing, it doesn't mean that you will be not sanctioned because it's a political process. And in a lot of the cases that we have seen, again, sanctions being pronounced against individuals or companies on the perception that they are breaching sanction policy because it has the illusion of being something that perhaps should not be allowed, when in fact, from a pure facts / legalistic basis, there has been no issues there. But again, we have moved away from a fact-based sanction policy to a perception-based sanction policy, at least in the UK and in the European Union. And as a result, you need to adapt your sanction and tariff compliance as well. It's not about facts only, it's also about perception. And if you are active on some trade routes that gives the perception that you're doing things you shouldn't do, that is also an issue. Because a lot of the sanctioning authority in the UK and in the European Union, they are basing the decision on the perception. and perception only. And that is a very massive risk that we are seeing now more than ever.
Hey, enjoying the episode? Tap follow for more. Done? Let's get back to it. Yeah, agreed. And I think you only have to look at some of the sanctions and tariffs that are being put in place from the beginning of the year, different governments coming into power. I think, we went over this very extensively at our Geneva conference, right? It seems to sort of change every few months and potentially new sanctions, new tariffs to kind of get around, and it's constantly changing. It's this constantly ever-changing world that is very difficult to kind of grapple with. Jonas, would you say, are there specific commodities or regions, would you say, is more vulnerable and susceptible to fraud? And if so, why is that?
I think the pattern that we always see in sort of our investigation is usually when there is an influx of fresh money into a sector, a commodity, a region. This is usually when a lot of the fraud are taking place. And I think that's what perhaps happened 5 years ago in Singapore, for example, where from the government incentives that they had given to different banks to turn Singapore into the capital of commodity finance, it resulted in banks being incentivized to essentially loan money to anybody they could to try to increase the amount of traders setting up shop in Singapore and working out of this. And then as a result, you can't have it both ways. You can deploy capital fast and to a lot of people, while maintaining good controls and due diligence process. At some point, you have to decide what is more important or what you put the priority on. It's the same we had seen and perhaps in Russia in the early 2000s, when they wanted to loan money to a lot of companies to simply push for the internationalization of the economy. The same thing happened. I think it's what we see sometimes from some Middle Eastern countries where they want to attract a lot of companies. They give up very easy financing, and as a result, that's when the problems begin or they set in play. Extra influx of capital makes you compromise on control and processes. And as a result, this is the breeding ground for fraud.
What would you say in terms of some of the risks brought on by digitalization, which is obviously, increasing year on year, but does it come with additional risks for fraud and financial crime potentially?
I think everything that is digital can be faked. That's a fundamental issue here. And I think especially in trade finance, we tend to see digitalization as the saving grace of the industry, whether it's blockchain or AI or simply pushing of more digitalization of documentation. And yes, it can help on some aspects, but obviously it comes with its own set of risk. Whereas, especially now with AI, right? You don't even need to be good at Photoshop to fake a document. You can simply ask AI to do it for you. In my view, it will increase the facility with which certain persons are conducting fraud in this market.
We've had many a private conversation about this. I've always been a believer in a joint approach. Obviously, we are embracing digitalization. I don't believe it should be at the detriment of proper boots on the ground due diligence checks. And I've always been a believer of that. I make no secret of that. Blockchain, how is blockchain changing the way trade-based financial crime and trade-based money laundering are structured? And how could this potentially be stopped without compromising the speed and anonymity that attract people to digital currencies in the first place?
I think it goes back to what you were saying, that being a big believer of having boots on the ground, I think blockchain is a great tool and I'm a big fan of the tech per se. But if you are relying 100% on just the blockchain as a solution, blockchain will just show what is being digital. But if you go and if you look into the container and you see that the container contains something totally different than what the blockchain say it should have, obviously there is a disconnect here between reality and a blockchain-based trade, especially when we talk about physical commodities. So what does the blockchain do? It simply ensures that the data, once it has been inputted in the blockchain, cannot be compromised. That's the only thing the blockchain does. So it has some fantastic potential application to try to reduce double, triple financing of transaction, for example, provided that everybody that is involved in the same market is on the same blockchain, which is very, very far from the reality right now. But the other issue is you should not forget that at some point, whatever data you have placed on the blockchain, if you make mistake voluntarily or involuntarily in the initial data set that you load up on the blockchain, then obviously that mistake will be perpetuated. And then you should not also forget that with physical commodities, obviously there is a physical good that is behind it, and that physical good can be tampered with regardless of whatever the blockchain is saying. So yeah, having that dual approach that you were mentioning is crucial in this, because I think sometimes we have the tendency to forget that, we are trading real goods, real steel, real coal, real wheat, and that all of these goods can be tampered, can be changed, can be stolen as well. Simple as that.
Couldn't agree more. One last question, Jonas. This has been terrifically interesting. This was again something we spoke about privately, which was kind of the rise of the deep fakes, essentially. And I know this is something you also have an opinion on that I think would be interesting to our audience. So as these AI deepfakes get better and better and more sophisticated, the usual advice given to finance institutions to prevent scams, check everything with a phone call, make sure emails don't sound off, is becoming less useful. What can institutions do to protect themselves?
I'm a massive skeptic of the benefits of AI because so far, at least in my profession, AI has been used to conduct more fraud than help detect fraud. So in itself, it has been more of a problem than a great advancement. And the key problem is that people tend to rely too much on technology to some extent, right? I think one of the key points that we have seen, obviously, even before AI started to appear, was that a lot of the time there are humans behind these screens. There are humans that are reading the email, that are giving payment instructions, making sure that the humans understand the risk with AI, they understand the proper practice of financial institutions, that they understand the proper practice of phone call with a bank works, prevention and teaching the staff and the teams as to what is a normal behavior is becoming more and more crucial. And I think more how to resist pressure from these AI scammers, how to make sure it's okay to ask for help and your boss is not going to be mad if you double check, one of these fraudulent email that you receive. So I think it needs to be a mindset change that is inevitable if we are to fence off the avalanche of AI deepfakes that has started to happen and that we will see more and more of.
That's very interesting. It's a whole new topic as well. And maybe with some additional time, it's something we can talk about a bit more. But very, very interesting stuff. And I think a very nice place to end on as well. So it remains for me to say thank you very much to Jonas for joining us. This certainly won't be the last time that we're having this conversation. Indeed, at the Trade Finance Forum, I'll be moderating a panel on fighting fraud, which is very much a kind of a boots on the ground approach. So we'll be continuing the conversation there. And I look forward to collaborating with Jonas on further discussions at all of our conferences next year as well. So thanks very much for your time, Jonas.
Thank you, Charles.